All right. Hello, everybody. Dividend stocks are in the news, and there's a lot of attention behind dividends today, but there's some warning signs that you might want to avoid as an investor. So I brought on Matt Frankel to talk about 4 dividend stocks that look really attractive, but we probably want to avoid. Matt, how are you doing?
Good. This is a reversal. Normally I'm talking about dividend stocks I love, so this will be fun.
Yes, exactly. And we can find your work on YouTube at Matt Frankel. I am Travis Hoium. You can find my work at the Rive Project, or just RIIV is the handle on YouTube. Matt, I'm going to get this started with the one stock that I think should have a lot of red flags out for investors. That's Annaly Capital Management. I looked up the yield this morning, 19.8%. You look at something like that and you go, oh my goodness, you get 20% of your money back in a yield within a year. That sounds amazing, right? But the problem with this business is they're buying up mortgage paper, basically mortgage-backed securities, and then they're borrowing money to buy those, basically trying to play the spread between what they can buy and what they can sell, similar to what a bank would do. But the risk has always been what happens when people stop paying their mortgages, when they stop refinancing, when you have to refinance the debt that you have out at a higher interest rate. You can be underwater on that pretty quickly. I remember this is a company I started following at least a little bit during the financial crisis because there was a similar case where the yields were really high. They actually survived all of that, but this time might be a little bit different. What are your thoughts on Annaly?
Well, Annaly, there are 2 factors that you have to consider with mortgage REITs like Annaly, and they're all a different combination of these. One is default risk. Are people going to stop paying their mortgages? And Annaly is good in this respect. Almost all of their mortgage portfolio are what are called agency loans, meaning those that are backed by Fannie Mae, Freddie Mac. So the default risk is minimal. If people stop paying them, these agencies step in and cover it. The other side of it is interest rate risk, and this is where companies like Annaly are suffering in the current environment. So as you said, they buy mortgages and they borrow money. They borrow at lower short-term rates because generally short-term borrowing rates are lower than long-term ones. If I can buy a 30-year bond paying 4% and finance that by borrowing money at 1%, that's a 3% spread for me. Same idea here. The problem is most of Annaly's mortgages didn't just get bought. These are from when mortgage rates were 3%, a year or 2 ago. So they're holding a portfolio of mortgages that pay, 3 to 4% on average for a 30-year loan. And they're having to borrow short term at rates like 5 or 6%. So in a lot of cases, mortgage REITs, their spreads can actually go negative in times like this. So that's the big concern. That's why the stock's been beaten down to the point where it's paying a 20% dividend. And at this point, Annaly's starting to look kind of like a yield trap, just like most other mortgage REITs are.
The other thing to think about too is what happens when mortgage rates go up like this. So when rates are going down, people generally tend to refinance periodically. So the average, if you're buying a basket of 1,000 mortgages, the way that Annaly is, the average duration that somebody's going to have a mortgage out might be 7 years because people sell homes every once in a while. Maybe they refinance, and then that mortgage mortgage gets repaid. If mortgage rates are going up and people are not moving, I think we're in a situation where people are kind of stuck in their houses, even if they want to move. Now that duration gets longer and longer. So now maybe instead of the average mortgage being repaid after 7 years, it's repaid after 12 or 15 years. And like you said, you're borrowing money at a short-term rate. So now you're at the whims of the market short-term, and that long-term rate that you have locked in is really low. And so it's kind of like the worst of both worlds for a company like Annaly, and can be really problematic. So I think the risk here, and what you said with the yield trap, is they may eventually have to just say, we're not going to pay a yield at all because we don't have money to pay out. And I don't know what they would do in that situation if they're going to run into further financial problems. But I would not look at this dividend and say this is rock solid, this is safe for the foreseeable future. In fact, the opposite. I would be shocked if it doesn't come down.
Yeah, these are companies. It's important to mention that they have ways to hedge against interest rates. It's not like rising rates are going to make Annaly go bankrupt, at least not right now. Like they buy interest rate swaps and things like that to hedge against it. But it's still the dynamics that rising rates are generally bad for mortgage REITs, and that's what we're seeing baked into the price right now.
What is the stock that you think investors should avoid despite having a very high dividend yield today?
Well, I don't know if I'd call it a high dividend yield, but Kraft Heinz is the one that comes to mind. This is the one that Warren Buffett got wrong, and I'd like to see people listening not get this one wrong. Kraft Heinz was a big pandemic beneficiary, helped Buffett out a little bit. People were stuck at home. They weren't eating out as much, so they bought a lot more Kraft products. Until recently, inflation wasn't going crazy. Kraft Heinz has a lot of debt. They are not a reopening play, I guess you'd say. When the end of pandemic restrictions didn't do them many favors, and inflation could actually start to kill their sales because there are cheaper alternatives to most Kraft products that in tough times people are more likely to buy. The generic mac and cheese is cheaper than Kraft mac and cheese, just to name one example. So they could suffer if the economy really takes a big turn for the worse. Their debt load is pretty massive. They have a lot of assets on their balance sheet that I question, like $30 billion of goodwill. That, take that with for what you will. I just think there are much better dividend plays out there, especially given the what ifs of what could happen in the economy over the next year or so.
I think it's worth understanding what's happened in that consumer space as well. It used to be, I remember a Buffett line that, you're buying a company like Kraft, you're buying shelf space. So you go to the grocery store and there's just a certain percentage of the grocery store that's just full of either Kraft or Heinz products. Well, that's great, right? Especially in a world where advertising is on TV and you're mass advertising to millions of people the exact same ad. Now we're moving into a world where niche products are a little bit more available and you're able to build those out. I mean, our local grocery store has got 50 kinds of mustard now instead of 2 when I was growing up. And that's because you can build these smaller brands. You can market more intentionally to individuals with companies like, Facebook and Google. And so it's really upended the power that a company like Kraft Heinz had for decades. And I just don't see that changing. I mean, I think that's the other kind of macro piece of this is that the world that a company like Kraft Heinz or Procter & Gamble grew up in just isn't coming back. And I question whether the scale that they have is going to be something that's going to really generate any significant long-term returns. So that's just something to keep in mind there. No, go ahead, Matt.
No, I was just going to say, it's one that I'm not going to be buying anytime soon. And in the consumer product space, there are a lot of safer ways to go right now.
Yeah, I totally agree. One I wanted to bring up because the dividend yield is shocking, and this is another one that if you're just doing a screener, sometimes you need to have your alarm bells go off. That is Star Bulk Carriers. Current dividend yield, 34.5%. And this is where you have to understand what a company does. This is a bulk carrier, and the shipping business, whether you're shipping dry goods, whether you're shipping oil, has been just crazy the last couple of years, partly because of the blockages that we've had in some of the ports, partly because we're buying more goods and shipping them around the world. But there's been a spike in demand across the board for shipping, and that's starting to unwind. And that's really the operational challenge that a company like this is going to run into. The other thing that I just want to flag is the shipping business is full of all kinds of self-dealing typically with the founders or CEOs, where they're buying the options to build a ship and then they'll sell it to the public entity. I'm not accusing anybody of doing that, but I think that's a reason to stay away from the shipping business altogether, is because you just never really know quite what's going on. And so that's why this is one that when I saw this, I've covered this space for a while. There's a lot of ups and downs, but you see a dividend yield like that, just run the other way.
Yeah, I would agree with that. That's one of the biggest signs of a yield trap. One good practice is to compare a company's dividend yield to its peers. And if one is just like one of these things is not like the other, it could be a really big sign to just run in the other direction.
Well, and the other thing, if you see a dividend yield like this, just look at a chart and see what does the shares outstanding look like over time? What does revenue and earnings look like over time? Is this a hyper cyclical business that, maybe they're going to pay a really big dividend in the good times, and then in the bad times, they're suddenly going to be issuing a ton of stock because they've got to fund the business. These are sort of the red flags that if you do a basic screen and kind of do a little bit of due diligence, you can usually find. But I have found over the last little over a decade, when it looks too good to be true in any business involving ships, it probably is.
Yeah, I would agree with that.
What's your final pick for us?
So my final pick is at&t, and it's not a terribly long pitch. It's just that there are, two companies, and I know you talked about Verizon recently elsewhere. And one of the biggest things that you said that stood out to me is that people are still going to be paying their mobile bills no matter what happens in the economy, things like that. My problem is that unlike Verizon, at&t hasn't focused on its mobile business nearly as much. They've spent, and not only have they not focused, they've made some of the stupidest acquisitions I can remember in recent memory. They overpaid dramatically for DirecTV. The same with Warner Media, which they ended up spinning off into Warner Brothers Discovery. They're starting to kind of right the ship, but in my mind, just enough's enough, especially when there's a company like Verizon out there that has invested the bulk of its money in its core business, the infrastructure surrounding it.
They made some bad acquisitions. They were just much, much smaller, like Yahoo.
Right. And that's fine. Like but when what did they spend? What did at&t spend on Warner? Something like $70 billion, something to that effect.
Yeah, it was in that ballpark.
DirecTV wasn't that much smaller, and that's essentially lost money. like they lost all that money. So it's just a history of poor decisions. I get that there's a new CEO in charge, but it's just a history of poor decisions. I don't really see where the growth is. I think Verizon has completely outcompeted them because of their smarter spending. They've put themselves in a position to have a big competitive advantage going forward. So this is like a case where it's essentially, I don't want to say a duopoly because at&t is actually number 3 now, I believe, compared to Sprint and T-Mobile. But those are the two big dividend payers in the telecom space. And to me, it's just a complete no-brainer that Verizon is the better managed company out of the two.
Yeah, I'd like to say that I disagree, but I don't. Verizon maybe they kind of accidentally didn't make a bunch of bad acquisitions. They made some terrible ones. They just weren't debilitating to the business long term. So that's why I like that one. But look, if you're interested in the telecom space, the other thing to mention is I don't think this is going anywhere. And just having a basket and just saying I don't know which one is going to win. There's only 3, so it's really an oligopoly there. If you are interested, but I agree that Verizon's a better investment. All right, let's go through our 4 stocks to avoid: Annaly Capital Management, Kraft Heinz, Star Bulk Carriers, and AT&T. Where can we find your work, Matt?
I am on YouTube and Twitter. Both my handles for both platforms is Matt Frankel CFP.
And I am on Twitter at Travis Hoium, and my YouTube is at Rive, RIIV. It's under the Rive Project. So I'm studying disruption there. So feel free to go out and check both of our work. Give this video a like. Of course, leave us any comments that you have about these stocks or any other questions that you have in the comment section below. And we will see you around here next time. This was fun, Matt.
Yep. Thanks for having me.